Welcome to 3 and 3. My name is Jason Weaver. Today we're going to be talking about 2008 banking, comparing that to 2023 banking, and looking at recovery times during periods of crisis. In 2008, banks had a credit problem. They had risky loans with very little safe assets. They actually had $23 of liability for every dollar they had in liquid cash. So they were highly leveraged and also very illiquid. As you can see from this chart, looking at the commercial bank cash assets, in 2008, they peaked, and you saw the dramatic effect of the Great Recession on those deposits, which had a tremendous effect on the banking industry and also the economy in general. 2023 banking is very different from 2008. Today, banks have a higher ratio of assets in cash and treasury agency securities. On average, banks have less subprime lending on their balance sheet. Today, the problem is liquidity and duration, or interest rate risk. Banks have used deposits to buy low interest-bearing securities when interest rates were low. As the Fed raised interest rates from 0.08 to 4.57%, those bonds have actually lost value. We call those hold-to-maturity securities. And as depositors now have asked for their money back because they're fearing that there might be a potential default on the bank, those banks are having to sell those securities and take that loss. And that's where, again, it's not about subprime or risky loans. It's really about duration mismatch in 2023. Now, looking at 2023 banking and comparing it to 2008, you can see that banks had less than 15% of their actual assets in cash and treasuries in 2008. As today, they have actually over 30% of their assets in cash and in treasuries. Recovery time. So history has shown that financial markets have rebounded from market shocks and post actually strong gains after the crisis is over. The average loss during a crisis is 16.7%. The average gain 1 year after is actually 31.3%. In 2008, when Lehman collapsed, the market actually fell 39.6% in 2 months. 1 month later, the S&P was up 18.3%, and 1 year later, the S&P was up 48.8%. As you can see from this chart, looking at crisis and recovery times, we look at, for instance, the attack on Pearl Harbor, which lasted about 5 days. The actual stock market lost 6.9%. 1 month later, it was up 4.5%, and 1 year later, it was up 16%. Now looking at the 1987 stock market crash, and that lasted about 3 days, a 20.5% drop. But 1 month later, again, up 7.1%, and 1 year later, up 27.9%. As we look at COVID-19 pandemic, that lasted again from about February to March, we had a 33.8% drawdown. 1 month later, we had a 25% return, and 1 year later, a 77% return. The average return 1 month later after the crisis is 9.3%, and 1 year later is 31.3%. Thank you for joining us for 3 and 3.